Alright guys, welcome back for another video. Well, today's video will be a little bit of a divergence from some of the uploads I've been doing recently, tracking my Bitcoin trade. And this will be a little bit more of a macro topic, but I do think it's very, very important. So essentially what's happening in this, credit goes to Luke Roman on Twitter. Follow Luke Roman on Twitter if you haven't already, but he broke this recent development in the change in the consumer price index. So essentially, we're on the U.S. Bureau of Labor Statistics website. You can see their CPI index webpage. This is the agency that calculates CPI for the U.S. government. You can see here the January 2023 CPI weight update. Starting in January 2023 data, the BLS plans to update weights annually for the consumer price index based on a single calendar year of data, using consumer expenditure data for 2021. This reflects a change from the prior practice of updating weights biennially using 2 days of expenditure data. Excuse me. So basically right here you have two different things going on. So first being they're changing the weighting to annually from biannually. So essentially, the CPI index used to change every 2 years, the way that they weight it, and now it's changing every year. And what's explicit, not necessarily explicit within there, is that change is actually happening right now. Whereas before, it would have happened biennially, so it would have happened at the end of this year. Whereas now, the change is going into effect in January 2023. Now, we don't know, we don't actually have access to the formula that they use to calculate CPI. It's proprietary information, but we just know that there's going to be a change, right? And the government has had a hard time dealing with the effects of CPI. So it's very unlikely that they, were to change the formula to make CPI read or print a higher print. Right, they're just not going to do that. There's no incentive for them to do that. So I think the incentive structure is there for them to change the proprietary formula to make the CPI give a lower read, and that'll actually go into effect in the next CPI reads. So that's distinct from these updated seasonal factors. So the new CPI reads, will reflect this new proprietary formula going forward. That is the ones coming out in February, next print. So here, a little bit more charts. So this is a good reflection of the 12-month change in the consumer price index. So these are basically your CPI levels for, basic goods and services that are within the basket of CPI, right? So remember, we don't know how what the measurements are or what the weights are for these different vehicles, but they do disclose which items are in the basket itself. So you can see here, and this green line marks December 20th to December 21st. So basically, the year of 2021 is marked in green, and the year in 2022 is marked in orange. So green is 2021, orange is CPI data for 2022. And you can see here that the big outlier and the big difference is used cars and trucks, which was way higher the previous year, and also gasoline. So gasoline is this is really the big one, right? Gasoline is very critical to core CPE, which is a different calculation of CPI, but essentially, yeah, that's a big change, and that'll have negative downward effects. Remember that the price of gasoline going down reduces the price of everything, because everything has to be moved around the world on combustion engines that all run on gasoline. So if the price of gasoline goes up, it just raises the price of everything. So it's good. You can see here that we'll go to the chart later for oil and by its corollary gasoline, and you'll see that decline. But This is very important here because this will have a downward effect on the real prices of goods, not just the manipulated prices of goods, right, from the manipulated data, but the real price of real goods will go down in real terms in a correlated fashion to the price of gasoline. So something to keep an eye on. Now, if we go to the chart data, this just puts it in percentage format. So you can see here, you got your 2021. This table should basically say 2021, 2022. So you can see here that, you did get a pretty dramatic rise within 2022. Which is pretty, makes sense if you're following the FOMC meetings, and that first thing out of the gate when Jerome Powell takes a stand is he says, we're committed to fighting inflation, and basically the rest of the conference is, spent talking about inflation and raising interest rates to tamper inflation. Now, the one thing that is interesting is actually meat, poultry, fish, and eggs were actually much higher in 2021 relative to 2022. I don't know that I've necessarily experienced that firsthand, at least from my opinion. Like, they seem to have been pretty high both years, but who knows? But when we get into the charts, we'll kind of see that, we know that the CPI has peaked around June of 2022, but we'll see that in the charts. Before I get into it, though, one thing to keep in mind is that CPI only tracks the prices of goods, or the prices of commodities, which isn't actually inflation. And it's a little bit of a misnomer to conflate inflation with rising prices, just because there are thousands of variables that can affect rising prices that don't have to do with an expansion of the money supply, right? So you can, in a normal world where you have a stable money supply, prices have more signal to them because there are still, even though the money supply is stable in this hypothetical scenario, there are still thousands of other variables affecting prices, that reflect economic conditions in the market. And because the unit of measurement used to measure that, which is the form of price, is stable, it's not subject to, debasement or manipulation, then those prices of goods have more signal. So I think that's very important. Like the debasement of the currency itself impacts the price signal of what the market is saying with CPI. So it's a long way of saying that the prices of goods is not the same thing as inflation. Inflation is the debasement of the money supply. The prices of goods is the prices of goods, which is impacted by the debasement of the money supply, but it's also impacted by thousands of other things, thousands of other variables. So a little bit of a nuanced thing, but I do think it is important to talk about because it'll help me conceptualize, how I cap it off with some of the forward-looking ideas after we take a dive into charts. So anyway, I pulled up a bunch of. Let's just go back here real quick. Any very core to any, like we mentioned before, gasoline and energy in general is core to any of the CPI, just because everything takes gas to transport. Not natural gas, oil, or gasoline. And, so oil is going to lead CPI. You can think of the oil chart as a CPI index, right? So it'll have a carryover effect on CPI, and this is actually very tradable, right? Like if you saw oil exploding, right, higher, and you were a savvy investor, you could make the a macro bias that oil prices are rising dramatically. That's going to rise the cost of goods everywhere, which is going to make central banks start to talk about inflation, which is going to make them raise interest rates, which is going to, have an impact on the markets. Now, there's a lot of if-thens in that scenario, but it's something that, in hindsight, would have been pretty obvious to deduce. And if, it's just a long way of saying that, you can use the oil chart to make a lot of inferences about what's going on in the macro picture in the world, and actually predict future central bank policy. So I think it's a very, very important chart that people don't really talk about that much. But anyway, I'll just dive into it. So I marked off the absolute peak in oil, and you can see it was in June. And when we go through the other commodities, you'll see that a lot of different commodities peaked around June 2022. Now, what's important is that oil has declined pretty dramatically since that June 2022. So, at a certain point, this will start to get priced into CPI, right? We don't know what the new weightings will be with the new CPI read, but it'll probably, I don't know. Who knows what it'll be? But regardless of what the new formula will be, it'll still plug in the price of oil, and it'll still capture this lagging data, right? So price is declining. Eventually, that will make its way into the CPI lagging data read, and it'll drive the rate of change in CPI lower. And remember, because this is like an index for all other commodities, it'll drive the price of other commodities lower as well. This is just the short term, of course. I'm not talking like long term. Long term, I'm very bullish on commodities, and of course they could go up in the short term. But again, just going back to the thesis that if you have access to oil that's nearly half as expensive as it was a year ago, your ability to pump out cheaper commodities is much more elevated. But what's interesting here is we've peaked out here, and then we came back down to this area down here, this point of release right here, where oil really started to lift off, kind of around December of last year, and we can see it kind of hit back down here, bounced off that level. We go to a daily chart, hit that level right there, and now it's starting to break market structure to the upside. And create new higher highs, right? Where you come down to this old weekly level down there, right here, come up, bounce into these highs right here, maintain the downtrend, set a higher low, and now come up, take the low right there, and mark off. Let's see. Put a mark right there. So we get a market structure break coming down into a high time frame level right there. There's probably some macro reason for why this market structure break is happening, right? Something in the oil market that we don't know about, or maybe we could know about, but I personally just don't know about. But we don't need to know about it, right? Because price is price, and you actually don't need to know what's going on in the world if you know how to read the price charts. You can see this break of structure. And that would, indicate a likeliness that, price on oil is likely to reach up to some area higher, at least in the coming weeks or so. Again, it's not a prediction for, the ultimate, a massive bull run in oil right away. It's just one price distinction. You can see right here, there's an area of interest right there. Then maybe potentially work its way up towards this greater level of resistance up there. But the idea is that, it's interesting because, you have the top here, and we can mark off this market structure break right here in oil. So CPI data is inherently lagging, right? And so what happens is when the Fed officials get up and do their speech about FOMC, CPI data, they're looking in the review mirror because it's backward looking, right? So, at this point, you've got a market structure break here. We've got a new Federal Reserve meeting coming up on February 1st or January 3rd. I can mark that off right here. Again, I just want to be clear about where my lines are. So you've got the next Federal Reserve meeting right here, FOMC. And, even though you've got a market structure break right here, it's very unlikely that, oil is just going to move up dramatically between, in the next week between now and the next FOMC, right? It'll probably be, somewhere where, close to where it is now. And at this next FOMC, they're going to be looking at the lagging data of all the oil declining, the price of oil declining for the last half year. Whereas if this is a market structure break, right, and price moves higher, it's just a good illustration of how the FOMC data is not forward looking. And, we could see a subsequent rise in oil prices that'll only be talked about, at the June FOMC meeting, right? Just as an illustration. It's a good example of how, all this monetary policy is lagging, and it gives them the conditions that they're looking for to declare victory on inflation, even if inflation, is obviously not going away or far, it's just, if you think about inflation as a series of higher lows in the grand scheme of things, if you think about every time inflation makes a new higher low, it has to trend down in rate of change terms to do that. And that's generally the area in the market where, the government officials and the Federal Reserve officials will start to declare victory on inflation, even though it's just setting a higher low, anticipating to make new higher highs in the long term. So we talked about oil. The oil is really the most important chart in commodities because it drives other charts. Natural gas is very important as well. This is a natural gas chart. You can see here that it, also topped out a little bit later than the food, commodities, and oil, topping out in August. But, it is, declining dramatically, right, since August of last year. So, this decline will be priced into CPI. And because of the lagging data, a lot of this, I kind of expect the CPI numbers to kind of drift downward over the rest of 2023. This is, this is a very, steep decline in natural gas, and there's no indication that this is over yet. This is a very impulsive move. Who knows how far prices decline, but it's pretty dramatic at that point. But really what I wanted to highlight is, this, you'll notice the consistency that prices of, oil, gas, and then the food commodities we talk about in the coming slides, they all kind of top out around this summer 2022. So if we go on to wheat futures, you can see the same idea, right? Actually, top is more like over here in May 2022, but you get the break of the this consolidation in June right there. So, you may not necessarily think it makes sense, but wheat and soy and corn are the biggest food commodities. Now, I know they're not exactly the healthiest thing, right? You don't want to have a diet that consists of wheat and wheat and corn and soy. They're just not good for you. But they do consist, they do represent overwhelming majority of the world's food supply, right? And it's just the mass industrial scale food commodities that are used to feed the world, right? And if wheat and soy and corn were to become very expensive, then you could get into a situation where there's more starvation in the world. So, something to think about when you're long wheat, soy, or corn. If it goes parabolic, people may die of starvation, or maybe something not to think about. Maybe you don't want to think about that. But, commodities do have very real world effects. Anyway, the price of wheat topped out in June 2022 and, kind of declined lower. Again, CPI is lagging, so this will get priced in. You'll see the food component of the CPI index decline year over year. So whereas we went up to 6.3 to 10.4, we'll probably see that sort of trend back down to 6.3 and then eventually 3.2. Same thing with oil. Let's see if we got Is oil on here? Yeah, right here. So I don't know if we'll see it go negative like it was this negative change in 2022, but we'll probably see it actually trend significantly below the 2021 rate and get closer to parity being zero. Anyway, let's go on to soybean futures. You can see the same distinction as we saw in wheat futures, topping out in that June 2022. It's almost like, the world was afraid of some type of, food shortage in June of 2022, maybe related to the Ukraine war, and somehow that, that uncertainty was resolved, or who knows? I mean, there could be a number of different reasons, but the key point here is something happened in the market to cause all these food commodities to top out around the same time in June 2022. So you see soybean futures topping out right there, and also corn futures coming in, topping at the same point in June 2022. Now, interestingly, my one of my girlfriend's cousins, he runs a stock brokerage, or actually a corn futures brokerage. So he would actually know a lot about this, but apparently they have him just fly over the country in America and fly over country just to look out the windows at the cornfields as he goes by. I don't know if he actually needs to do that for his profession, but they do pay for him to do that. And again, corn is important just because it's such a large component of the American diet and also the global diet as well. Now, one other thing to know about these commodities, wheat, soy, and corn, because they are so important to avoiding starvation and serious societal issues, being this mass-produced agricultural product, they are very heavily subsidized by the government, and that is something to keep in mind. I'm not really an expert on how those subsidies affect the price. I would assume that it contradictorily, almost ironically, puts a floor at the price that keeps the prices elevated over time, just because those businesses that are subsidized, they can operate just without really worrying too much about the margins, and they probably also have a lot of government guarantees for their debt as well, because the government can't afford to have like a major producer of those products go under. That would cause severe issues. Now, I couldn't find a data tracker or really a price chart for poultry or meat. We were talking about corn, wheat, and soy, all stuff that you really don't want to have too much in your diet. I mean, if you didn't have any wheat, corn, or soy at all in your diet, you'd probably be better off. But as far as poultry, and meat, which is absolutely critical, those prices haven't gone down in the same way that some of the mass-produced wheat, corn, soy have gone down. But livestock feeds have gone down. So you can see right here, livestock feeds. And this makes sense because livestock feed is basically just corn, right? We'll go to corn, or it's right here, corn futures. So corn futures topped out in June 2022. And livestock feeds topped out in June 22 because livestock feeds are basically corn feeds. So corn actually has a lagging effect on the price of beef because cattle, use that as livestock. So if the price of corn drops, it won't immediately have an immediate impact on lowering the price of beef, but it'll have a lagging impact because now they can, the slaughterhouses or wherever they're raising the cattle can now afford far lower feed costs. And that translates into lower operating costs and lower beef costs passed on to the customer. So that's good. I mean, of course, there's a lot of other, variables affecting the price of poultry or beef. But this is one promising development here. Anyway, I'll just circle back just to the consumer price index and just kind of revisit the idea that, the CPI data index is changing, and the proprietary formula the government uses to calculate the CPI weight is changing with it. So, personally, my bias and my expectation going forward to the next FOMCs is you have a combination of commodity prices are actually declining in real terms since summer of last year. So that will be priced into the market. And then you also have the adjustment in the CPI index from the government that's being adjusted down on the back of falling real commodity prices, those core commodities that we talked about, like oil and food and things that make up, that have an impact on the rest of like core CPE and other kind of tangential measures within the CPI index. So I think those things in combination, I think, the type of discussions that will happen at the 2023 FOMC meetings will be a little bit different than what happened in 2022. Whereas in 2022, the conversations were dominated by CPI and inflation. I think that, especially as CPI starts declining dramatically, I think the conversations will start to shift towards job losses and some of the negative impacts that monetary tightening has had on the economy. Because the situation is so volatile, I think people might be a little bit surprised on how quickly the conversation switches from inflation to deflation, right? So I think it's important to be a little bit nimble with that mindset, because things can change incredibly fast, and talk about deflation will probably be confluent with some type of impairment in the bond market due to the federal funds rate trading above the most of the yield curve in the bond market. But that's an entirely different topic for a different video. Anyway, I hope you guys like this video. If you haven't subscribed already,